we're currently in a bull trap. This rally is fake, and we believe that it's going to dip not only to what it was before this rally, but lower. That's my personal thing. I don't know what you think, Vitaly.
Yes, I'm of the belief, after being in a lot of bull traps, falling for all of them. I never even knew back in the day, like when 2008 and 2001. When you're younger.
Yeah.
I did not realize what a bull trap was. So like now it seems a little bit more evident what's happening, because right now the market recovered really fast, like 30% up really fast.
Right.
And you can say, yes, we've hit the bottom, and then it all just comes back. And no, the businesses are closing. There is no way, when businesses are closing and people are losing jobs, that someone's going to run out and buy the next high-end iPhone, the next Tesla.
Exactly.
I'm not saying they're going to stop making them and no one's ever going to buy a Tesla again. I'm just saying that there's got to be a hit to the economy that's real, and it can't be right away we're back to recovery and now we're looking for new highs, because that's what they're talking about on CNBC.
More people have applied for unemployment now than in any time in history. And at the same time, nobody has any money. No stimulus checks have gone out. They don't plan to go out for the rest of the month. Bills are due. No one's going out and buying stocks right now. I think we are in a bull trap, and I do think that this is going to not only go down to what it was before this 30% rush, but I also think that it's going to go a lot lower than that. So I'm switching my strategy now to see how we can either use put options on the stocks to make money as they go down, or to find a way of essentially putting a put option on the entire market.
It's ridiculous that this is just an automatic recovery, and the way they're discussing, like it can go up higher and higher.
Well, just over the weekend, they announced that the stay-at-home order is going to stay until April 30th. This is very different from
right. Do you see how they keep pushing that forward?
Yeah. But
and it's smart. That is actually the smart thing. You want to push it slowly forward. You don't want to tell everybody they're going to be here for the whole fucking year.
Exactly. So there's a bit of that, and that's, I think, the markets were responding to the idea that we could be open for Easter.
For business.
Even though everyone knew it wasn't going to happen, people are just saying, hey, just in case, let me get a little skin in the game in case this thing goes back up. Then it comes out this weekend that we're now going to be closed until April 30th. The news coming out of New York today is saying that, that they need help. And so this is not over anytime soon. And if this is not over anytime soon, this is going to have to drop, just because people are going to want to, again, hold on to their physical cash.
$1,200 per person if you make under $75,000, and then $5 is taken off every 100 or something. So
if you make 90,000, it's like 200.
Right. If you make 99,000, I think
it's like
then you get nothing. You get zero. I'm not sure about the kids though. You might get for the kids still, so I'm not sure about that thing. $500 per kid.
You might, but either way, it's not a life-changing.
I better have some kids right now.
it's
have 4 or 5 kids.
Jesus Christ. You get your own reality show. I don't think either one of us is going to get a stimulus check. I know for a lot of people it's going to help them, but I think that for them.
Oh, no. I'm looking forward to people getting, even if I don't get it, fine. I don't care. And which is a little bit messed up, by the way, because me and you are freelancers. And this channel is called Freelancer Finance, right? Supposedly, let's talk about this for a second. So let's say a freelancer made 6 figures last year, and all of a sudden they have no work for 3-4 months. How are you looking at their 2018 tax returns and giving them nothing because they made over $99,000?
Well, they're assuming that everyone's living, that even if you're making $99,000 or $100,000 a year, that you're living at a $50,000 or $60,000 standard of living so that you can save the rest of the money. That's what they're assuming. They're assuming that everyone.
If you look at American statistics, that's not what the assumption should be, though, right? It's like people have $400 maybe for one-time problem.
Yeah.
That's the average. I'm not saying me and you are in that position. Maybe we're a little bit better off. Fine. Because we're actually looking at the market and we're trying to invest. But that's a lunatic thing. What about the guy who who doesn't have any customers right now in his business? And his loan, I know there's going to be an SBA loan and all that happens, but even that, you have to jump through a bunch of hoops. It's not like it's an automatic guarantee. So there's a lot of problems with their solution, right?
Exactly. And the details of that didn't really come out until this weekend. People really started looking at it and doing the calculations. And if you're a couple and you make over 150,000, you're basically on your own. So it's a matter of generating money on your own, or using whatever liquid capital you have to float yourself, or credit cards to float yourself until you get to that point. Why I think talking about our strategy this week is important is because everyone recognizes that this is an opportunity to buy. And, you know, after the market crashed 5 years later, everybody was like, oh my God, I wish I threw money in 08. Well, everyone was broke. Nobody knew when we were going to make money. We had you know, in our industry, we also had like the writer's strike was another time when nobody knew where they were going to have money. You don't want to part with your liquid cash.
Well, that's the thing. I see a lot of good deals, but from what you're saying. Even Twitter. I had Twitter and I sold it at 36. I didn't have a lot, 100 shares, 200 shares. As it went down, I sold it off.
Right.
It's not a lot of money, but now it's at 25 and it went down to as low as 20.
Right.
That's starting to look like a good deal. But they actually make income. And what are you going to do at home? You're going to sit at home on Twitter.
You're on Twitter. You're
on Facebook.
Yeah, you're on Facebook.
So I think those companies are going to do well, but do I think that they're at the bottom yet? I don't.
But even if you knew that they were at the bottom, if you don't know what your income's going to be for the next couple of months,
right? You have to preserve income.
You have to weigh that and say, yeah, there's potential gain to be made here. What is the potential gain, and is it worth me, you know, taking money out of my debit, my actual bank account that I need to pay things like my mortgage, car note? Those things can't come on credit. Yeah,
it's a good discussion because freelancers, even though we're filmmakers, we're still freelancers. So it's a very similar position to what lots of freelancers are in. Even people working in restaurants. So all of this, they're all closed. Who's going to go to a restaurant right now and even risk bringing it home to their family? Like, I'm not going to do that.
It's not happening.
Well, I agree with you. A lot of people have taken out money just to see what happens. I agree with you there. And me too. And you too.
Me too. This is the money that we're playing with now.
Yeah.
As we're trying to, and we're weighing how much we feel like we need to keep on hand and how much we can throw back in the market.
I'm keeping a lot. I am keeping, I'll be honest, at this point, it's over 50, I think 50, 60% in cash. Let's go into an example of what you're actually doing. And then I do want to talk about, because I think I'm doing slightly different. I'm not going to do all this calls and puts. I still don't know enough about it. So let's go into your thing first before we, hit a little bit of mine.
Real quick. The first thing I was going to look at, originally I was going back in and we both talked about purchasing these stocks as they go down. I think they call it catching the knife. You kind of purchase the stock as you see
catching a falling knife. Yeah.
Catching the falling knife. So Uber was at 30, it starts going down to 25. Maybe you might go into your portfolio, put a couple of limit options in at 27, at 25, at 24, and then go really big at 20 or 15. Like a week and a half ago, which was like the
it was like perfect, and we missed that.
UVXY.
Yeah, UVXY.
And February 21st, it was at $12, and this is like a short. As the market tanks, this ETF goes up. I believe at that point to buy in will be at some point this week when it's up at its actual peak. And then as the market tanks, we should be able to see this thing going back up.
Well, if it tanks further than the 30%, that 110 should be, there's going to be a new high made on that. On what is it called? UVXY. There's going to be a new high made if we believe it's going down further.
And then, but Phil, who you met the last time, was actually recommending to look at this stock. This is the VIX, which apparently is also doing roughly the same as this, but there's a different buy-in price point.
I'm not sure. Is VIX also tracking short? Isn't that a Vanguard fund?
It's a measure of volatility. So basically, these stocks, these ETFs are trading based on the volatility of the market, not necessarily the stock prices.
Basically, the more volatile the market is, you're saying VIX goes higher.
Yeah. I am not an expert on any of this, but I do know people that have made money investing in these two particular ones, just because it's an easy way of essentially shorting the entire index versus going in and finding individual stocks.
My three favorite stocks are Lyft, Uber, and Tesla. And there's also Enphase. I really like Enphase. So I have buy orders for all of those, by the way, as it goes down. Okay.
Enphase is looking better and better.
Well, I have a $30 buy order. I just to recap, I bought it at 23 when it did tank, and I sold it at 39 and change when it hit its peak, just like this last week. I didn't have a lot. I had like 100 shares, but I was like, anything that doubles within a week, I think I should just get rid of, honestly.
But I mean, but considering, but doubling is, the idea that a stock doubles, it's not like Amazon doubled. I mean, this stock doubled.
No. It's a small stock, but anything that doubles, I've learned, at least from, I'm not no expert, but I've learned that anything that doubles so fast usually has to retrace, and it has to go and test again that other, this Fibonacci sequences. There's a bunch of things we can discuss, but basically it has to retest somewhere lower to see if it bounces off. I sold it at 39.
But like, do you remember around what date?
It was literally at the peak. Look at when it would hit 39.40. If you, that's when
it was up to 56 on March 5th.
No. We're talking the last week.
Oh, so you bought it like March 18th when it was like 23. And then,
that's right. I literally bought it when it hit like almost the low. I think it went to 20 at some point, but I got it at 23 because I was like, I like Enphase. I like Enphase a lot. And it's obviously, Enphase, for anybody who doesn't know, is the microinverters on the solar panel. So I think Enphase has a very bright future, and I want to get into it way harder.
Very bright future.
A very bright future. Yes, a solar pun. But so I got it at 23, and I was like, all right, I'm going to keep this. I'm not going to sell it. Blah blah blah. It's already a good price, and it hit 40 within like days of when I bought it. I don't know if you can bring up that bigger image of that chart.
This is 5 days.
Yeah, there you go.
So up around here, 38, 39.
Yep, and
around there, and
then it went down. I think right where you're pointing in the beginning, 38, 39. I sold it right away, and then it dipped, and then it went back up a little bit.
Yeah,
and then it just started falling because it has to retest. It can't just go up double. Like even if it's worth it, these what I've learned, at least from watching the market for years, is that all these people on Wall Street love to retest certain numbers.
Right.
So even though they think it's worth more, they'll still sell it off, and it'll retest like the $30 or the $25. And that's what I have. I have a $30 buy, and it's pretty close. It might hit it, I think.
Oh, 30 is actually a good, it's a good, because it's a little lower than what it is. And even if it hits it for a second,
that cash has to sit there like a good little boy, like a good little soldier. Right. Like Mr. Wonderful says, it has to sit there like a good little, and then go to war, right? It has to go to war for the right things. I'm quoting Mr. Wonderful here.
But it can't. Now's not the right time to be purchasing any
big items.
Commodities. No, right now is about purchasing things that are going to make you money in the future, so that you can purchase that Tesla. When we get out of this, you can purchase it hopefully at a 30% to 40% discount versus the money that you have now.
Well, what I expect, if this works out well for people who can at least invest in the market, because not everybody can. And I believe everybody should invest whatever they can and during a downturn. That's like your opportunity.
That's another thing.
That's your opportunity.
That's another thing. That's another thing too. This is an important point. We might even put the graphic on screen. Is that if you're thinking about buying, if you're not in the market now and you don't have a lot of money, my recommendation would be take something. Throw in anything. My portfolio, I started my portfolio probably 2002. Everything was down. And I started it with $90. And you realize that once you have even $90 in the game, you're looking at the stocks every day. You're checking them to see how your money's doing.
Your mentality. I'll give you an example. Like Enphase we were looking at, if you can bring that back up. But getting whatever, let's say a person can't afford 100 shares. That's a lot. That's thousands of dollars.
Yeah.
Dude, that one share of Enphase, well, we can talk about market cap. What's the market cap of Enphase right now?
Their market cap is $3.9 billion.
No, $4 billion. Okay, just to give you some clarity for people who don't know, Apple's $1 trillion company. Okay, this is a tiny little baby company
compared to.
And Apple. Compared to Apple, if we think solar is going to be successful, this is one of the companies. This is not financial advice or anything, but this is one of the companies that is set up to be, $100 billion company, a $200 billion company. Like they're set up for that because they're killing it right now.
For Enphase to double their client base, when you look
at nothing, right? It's nothing
that are in California or the amount of roofs that are in New York City or in the country. For them to become an $8 billion company is nothing. It's a tiny dent.
No, it's nothing. I mean, I think if this was a good year, they would. I think they were already at $60. But what were they at? Their max. They were already at 60.
If you look at their max ever, they were at $60, and that was February 21st.
So they were double. They were an $8 billion company, by the way. This company wants to go up. they got all the growth happening. They're making money. I'm telling you, this company wants to go up. And the only thing holding them down at $30 right now is because obviously we're so uncertain of the future. And the only reason I'm not throwing in 20 grand right now into them is because I'm uncertain of the future.
Yeah.
You know?
Yeah.
But let's talk to the people who can't afford $1,000. Get 5 shares of this. Get 1 share of this. Just start accumulating this.
Get 1 or 2 shares of it. If you think it's going to go up, get 1 or 2 shares of that.
And once again, not financial advice. We're just talking between ourselves.
My strategy this week is switching from purchasing the stocks outright to either investing in indexes that track the volatility of the market. So something like a UVXY.
Well, that's basically betting on the market going down, right?
Yes,
betting on the market going down.
All of the stuff now is becoming short-term investments, or investing in outright buying securities if they hit a certain target low. But considering that we're in what we think is a bear trap, whatever prices we're seeing now, we're thinking that that's just going to come down even lower. So there's no point buying them now. I bought a little bit of Disney this morning just to round out the numbers in the shares that I own.
Right. Get that nice round number.
Just get it at a nice round number. But other than that, it's more about trying to capitalize on the volatility, which is something that I've never done. I've usually just sat these moments out. These have been the times that I normally just sit back.
You're right about that. Me too. I've sat these moments out, and it would be nice. It would be nice to do a put option if I do believe Tesla and Uber are going down. I haven't looked into this too far yet, but
let's just do it. Just do a put option for. But we can look.
I don't know what it is right now. Well, can you bring it up? Let's quickly see it.
Let's look this up. If they said that this is May 5th, then we want to look at May 8th, and we only want to look at the puts. All right. So these are a strike price of $25 Personally, I would do a $45 put option on these guys. Right now, what this would cost you is, if you got it at the bid price, you would pay this person $1,720 to control 100 shares of LYFT for the right to sell it at $45 any point between now and May 8th.
Right. Yes. Okay. Yes. And I guess you'll have to work out the math if that works out, because it's going to be $45 minus the $17 where you have to be profitable. It has to be underneath that, I believe.
The price, yes. If you were to buy it at $17.20, right? If you were to buy it, so 45 minus 17.20.
Or $17.
To be above $27.80.
No, below. It has to be below.
Right. Yeah. It would need to be below that for you to be making money on this trade. So
that's not a bad bet. That is something that I think can actually happen. So if you're not flush with cash and you want to make a bunch of these bets and you think something's happening, I can see why this would work out. You know.
Right.
Because all you can lose is $300. I mean, honestly, even if you lose $300,
you're not
ruined.
Play with it, because the other thing too, because you could always just cash it out and even if it was, for example, at $300 right now, let's say that the price of Uber was $22. Let's say that it went to $22. If it went to $22, you're going to be able to sell it at $22, and you're only losing 75 cents a share. So the price of your option was $300, but if you exercise it and it's at $22, you're going to end up at a total overall price of about 50 to 75 cents per share. So
you can use it. What you're saying, let me see if this is true. You can use it as a hedge for the price. So if the price goes down, and even though, it doesn't go down where you're going to exactly, so you're not actually losing a lot, even if you buy those shares.
Yes.
Like if you basically, so you might be paying more, but this is like a hedge. You're like, okay, I'm not sure where it's going to go.
But what it means is, as long as the price of the stock goes down, when you exercise that option and you sell those shares, you're actually earning back some of the money that you paid for the option to begin with. So you're cutting back some of the losses. You're still going to lose, but with this option, you have a chance to make some of it back, versus owning the stock outright and being along for the ride. Now,
how long is it? Can you check this real quick? How long is it for like a year from now to hold on to Uber shares? Let's say you can't afford, because this would be maybe an interesting strategy. If you can't afford the shares right now, like as many as you want,
right?
But you do a I guess, a call option. It wouldn't be a put option. Let's say a year from now,
Call option. Well,
just to control those shares for a year or two until you can afford to buy them.
Exactly. If you like this price, at $26, but you don't have the money, this is again talking to freelancers this is again talking to a freelancer. If you have say $1,000 right now, you could go and put $1,000 into Uber and you would be able to buy, if we average this out, let's just say you have $1,000 right now.
You wouldn't get as many shares. You wouldn't get as many shares. That's the bottom line.
If you go to $26.92, you're going to be able to control 37 shares of Uber right now. That's what you would have. That's what
Lyft in this case, by the way.
If you bought them outright, you would control 37 shares of Lyft outright. Versus if you had a call option for $26, if you wanted to find one.
Well, let's look a year from now. Can you go a year from now?
But again, the length of the option does affect.
No, I know, but let's see. Let's see what that cost is.
So let's say if you wanted one going as far out as January 21st, and you wanted to purchase, you wanted the right to buy 100 of these shares at this current price. So if you're looking around here, look
at that at $5. What is that? What does that want at $5?
This is for the ability to sell to buy.
No. That's a call. That's a call.
Yeah,
so
that's a call with a strike price of $5.
No, you're buying it for $5. And you're paying the bid ask of 20.
I know. But what I'm saying is, if you wanted to have as many shares as you could have of Uber right now for $1,000, I'm sorry, of Lyft for $1,000.
Oh, I see what you're saying. Yes.
What I'm saying is,
you want the bid ask low.
You could buy them outright and you'd have 37 shares.
Yes.
But for the same $1,000, if you wanted to purchase them close to what they're at, 25, so you'd look at one of these two call options, let's say you looked at this call option, this $27.50, roughly the same price right now. If you got it at the bid price of $895, you would be paying $895 to control 100 shares versus.
Right. Well, actually, do the same math. So do 1,000 divided by like $9. Do 1,000 divided by $9.
You have to buy them. You have to buy them as a lot. You have to buy
right. So it's one lot. It's one
contract. So one contract of Uber right now at a bid price of $895 would cost you $895 to control 100 shares of Uber and be able to buy them at this price, $27.50, at any point between now and January 22nd.
And you'd be making the bet that they're going to be worth way more than $27.50 plus the $9. That's what you're making the bet.
$27.50 plus the $9 that you're paying now. Yes, because at some point you do need to come back in and purchase those shares. But the point is, if you don't have the money now, if you have $1,000 right now, you could put that $1,000 into a call option on Lyft to be able to control 100 shares of it at $27.50 any point between now and January 21st, 2022. Or you could take that same $1,000 and you could purchase the stock outright and only own 37 shares.
Look at this. This is actually looking interesting for me if I was to gamble. So look at the $52.50. Look at the strike price of $52.
Yeah.
Oh, actually, go to $57. It's even more interesting. Right. Look at that, 71 cents for the bid.
But this is a call option.
Yeah, I'm looking at the calls. So let's say you're assuming, okay, let's say Lyft really takes off in a year.
Right.
It's this low market cap company. It's like 5 billion now or 6 billion, 7, whatever, somewhere in there.
Right.
It can actually go way past $60.
It could go past $60, but the reason why this option is so cheap is because Uber would need to, Lyft would.
Well, no, that's what I'm saying. So if you wanted to control 100 shares, how much are you paying for that?
But here's the thing. But here's the problem.
No, this is pure gambling. But I mean,
it's pure gambling. Here's the problem with it. The problem that I see with
$70
is you're paying. You would pay $710 for this option.
I'm getting no. You'd pay $70.
Right. Okay. You're right. You would.
I'm getting this. I'm going to buy one of these.
No, but here's the problem.
$70.
It's $70 for the right to purchase 100 shares of Lyft at $57.
No, I understand, but this is like one of those bets. Like for $70, if I'm right and it goes past 60, if I'm right and it just explodes because the economy is like booming and a year from now or however long this takes,
All right. So it's 81 cents. So you're going to pay $81.
Damn it, it went up. It went
Yeah.
up 10
So
cents.
$81. This gives you 100 shares until 01, what was it, 2021.
Yep.
All right. That's what it gives you. Now, this gives you the right to buy 100 shares at $57.50. Okay? So when this thing...
For cheap.
This is $57.50, but the price...
Right, and if it's underneath $57.50, you don't execute that. You lose your 81 bucks.
So what I'm saying right now is if Uber goes up to $100, okay? Now, $100 minus $57.50.
It's pretty good.
Okay? You're making $42 a share.
Yep.
$42. You're making $42.
$4,200 you're making off of $81.
Right. And you're set to make a $4,200 profit. Okay? In order for you to make this $4,200 profit, when you convert this, you need to pay this.
No, I understand that, but you're missing the point. If you do the return on investment of $4,200 from $81, we can calculate it out. It is a massive. Hold on. Getting $6,000 together to make $4,200 is a no-brainer. Okay, that's just anyone and their mom will do it. I'm just saying this may never happen, but that's why it's only 81 bucks you're only risking. This may never happen. It's a low probability. I want to know the percent return on this.
It's 51.
51x. 51x.
But it's
I would say.
But it's not, you have to understand, it's not 51x.
It is. You're only putting $81 at risk. I know you have to buy your shares. I get that. I think you're missing that point. That doesn't even matter. I'll go to the credit card and buy it and return it the same day. I'll go to my credit card, get $57.50. I'm not even kidding.
Let's just say.
Sure.
Let's just say. So right now you do a call option.
While you do that, I'm going to go buy 500 shares of this 81 cent thing.
Look, do the call option.
That's why our show is good. This is why.
So for this one, it's $21.80. So for this one, you would put $2,100.
$2,200, but okay.
$2,188 is what you would put.
Yeah. $2,200.
You would put that and you would have 100 shares. So it goes up to $100 a share. At that point, you would need to put $500. You would need to pay $500 to convert it. So you paid. No.
So you're right too, by the way. This is not a bad strategy. I'm going balls out. I don't want to spend any money.
You're raising the strike price to somewhere above where it is now, but not to where you think it's going to go.
Right.
For the sake of coming very little out of pocket.
Basically, I would do both. First of all, if we're going to go into I'm glad we're talking about this. I would do your way and my way because it costs you $70 or $80 to take a chance that you're going to make a 50x return. Do you understand that? Well, that doesn't happen. This is why this is powerful. This is why this is so powerful. 50x return.
Well, with your strategy, what you're saying is I would rather hedge my bet so that I'm only going to pay the big money when I'm sure I'm going to make money.
Yeah, well, the problem later is right now we're in a point where money is so tight, meaning we don't know what's happening, that I would think we'd want to hold on to as much as possible without spending more. So my initial strategy is looking at your, at this puts and calls. I wasn't even going to do it really, but now I'm feeling like I should take this chance for $80. It's like a stupid. It's like a stupid. If the economy actually does this V that everybody's talking about, I make 50x. It's insane.
Well, look, the way to do it, the way to do it, I think, because I think that $57 a share is a bit high.
Yeah. This is a total what if. That's what this is.
But if what you want to do right now is if you want to cap, let's just say what you wanted to do is to cap your initial investment. Let's say for every $100 you want to control 100 shares. What you want to do is you want to look for a bid price that's around $5. So
there is one for 5 right there.
You want to look at one of these in here, like this guy, $40. So a nice even number. You want to look at this one here. So for this one, you're going to pay $500. You're going to pay $495. You're going to pay $500 to be able to control 100 shares. And later, should you need to convert that, you're going to have to pay $4,000. You're going to have to take $4,000 out to convert this later, but you're only converting it because you know you're going to make money. And
right. So I don't care about, see, the conversion part does not bother me if I am up like double.
No,
So
you're up. Right.
I mean, it's more than double because you're only paying $5 per share as opposed to $40 per share. So you're saving a fortune if you think it's going over, in this case, over $45. So I'm not saying it's by January, but this is not a bad bet for $70 that if it flies, you know, when things fly, they overshoot too, right? And I'm willing to risk.
Like we talked about last episode, there could be a bunch of people that are shorting this stock right now. And if we get that turn in the V,
it's just going to flip, right? All those that short squeeze, boom.
It's going to be a short squeeze. They're going to short squeeze the shit out of those people. They're going to be buying the shares. It's going to jack up for like a day or two. Then it's going to level off.
But we can sell it, right? We can sell it anytime with these options within a year. For $80, you get to basically say, that's a low risk to make 50x. That's my point. I know this is like gambling too. I get that part of it.
It's gambling. But what you're saying is by increasing the strike price, and this is good if you're trying to use these to make money. By increasing the strike price to a price that is above what it's currently trading at, but below where you think it could go, what you're saying is, I want to control the shares for as little money as possible. And I will go into the bank and pay the $4 or $5 grand to convert these.
Right. And if I lose the $80 and I'm totally wrong,
I'm not crying over losing it.
But if I make 50x on $80, OMG.